oftentimes, despite the fact that people say if you're going to be a long-term investor, you should have the discipline not to sell then, if that's your strategy. Oh wow. He doesn't like that strategy. What would you say if I told you that for $16 a day for 41 years, like if you started at 18 years old, putting $16 a day away, that after 41 years, you'll be worth $2.3 million. And that's just in your special tax-free account. Yes, that's true. It will be actually tax-free. Would you say this sounds like a scam if you read this online?
You couldn't even buy a house in Watts for that.
I don't know what he's talking about, but what I'm saying is, it sounds too good to be true that you could have this incredible amount of money and you won't have to pay any tax on it whatsoever. But that's actually the real reality. It's called the Roth IRA. And you probably heard about this and thought, that sounds boring. I don't want to focus on that because it's not that interesting. But with this, what a Roth IRA is, it's like a box that's everything in it that gains in value is tax-free. You never have to pay any tax whatsoever on the dividends or the capital gains. However, you do have to pay a tax when you first put the money in. That money is taxable. They call it after tax because you already paid the tax on it. Now that money is yours. You can invest it in your Roth IRA as long as your income is below a certain certain amount, like 125,000 I think for an individual and more for married. But if those conditions are met, you can put your money into something that you never have to pay tax on. Now, what I would recommend putting your money into, one thing is a relatively not so volatile, is the S&P. What do you think about that? Because I looked at that, over 90 years, the S&P has delivered like a 9.1% return. You know, like a lot, I notice online people always say, oh, the stock market goes up 7%. But I looked up the S&P, it's actually 9.1% a year over the last 90 years.
Volatile.
So what I do recommend is stocking away this money, especially if you're younger, because you actually benefit from compounding. Because the more years you have to actually invest, the more likely it is to actually increase substantially in value. You understand how the compounding works? How does compounding work?
What do you tell them?
Okay, compounding works by, let's say you make 10% one year, so you go from $100 to $110. If you make another 10%, you're getting a gain on top of the 10% that you already made.
How about compounding losses, where let's say you buy a stock at $10 and you say, oh no, it's down at $9, and you sell it at $9, then it goes up to 10 again and you buy it back as it's going back up, and then you sell it when it goes back to 9.5, and then you buy it back when it's at 10 or 12, and then you keep compounding your losses.
Okay, well, that's confusing people. Anyway, most of the people who watch my channel, this is how most people are, and I assume a lot of people on my channel are like this. You probably don't want to trade, you just want something that you can just kind of buy and you don't ever have to really worry about it. And so that's why a lot of people, including Warren Buffett and even Graham Stephan, recommend just using the index funds. And of course, nowadays index funds are pretty cheap. The expense ratio, which is expenses are a way of taking away money from your wealth, because inflation and expenses of the fund are what determine how much wealth you have over the long run. Because if the expense is like 1 to 2%, that's a lot of money that the fund is taking away from you, and it's not really necessarily benefiting you. So there are a lot of companies that have really extremely low expenses and that you should consider using as your Roth IRA, like Vanguard or Fidelity.
And that's lower than Vanguard.
Yeah, Fidelity has it at 0. You don't have to pay a damn penny. And so
they're hoping that you're going to switch over to some more risky bets.
Well, in the meantime, it doesn't matter what the motivation is. You can say, hey, McDonald's has the dollar menu because they want you to order the more complicated things. Who cares?
Wealthfront, they were giving out the highest interest, and then after the economy went into a severe depression, now they're back to super low, 0.26%. Okay. Or you can get a better savings account at American Express now.
Okay, but this is not where you would,
1.5%.
this is not where you would put your Roth IRA, because for your Roth IRA, it's all about gains from your capital gains and your dividends, and you don't, because if you buy something like the Nasdaq and put in your Roth, you might have trouble sleeping at times, because the Nasdaq is going to be way more volatile than the S&P. The S&P has kind of more cyclical companies. Nasdaq has the technology companies, and usually technology companies and pharmaceuticals, they're going to have much bigger swings because they're usually trading at way more expensive multiples than the S&P. So the number one thing is, yes, for $16 a day over 41 years, that will really result in $2.3 million. And I know that my brother here thinks that that's nothing, that chump change, because maybe in 41 years
the S&P lost 50% of its value in 2008.
Yeah, but okay, let's say that someone did, but let's say they want to be a passive investor. Did they lose any money if they didn't sell it? They just kept it? They didn't lose any money then. I mean, long term, they didn't lose it.
They were able to hold it.
Okay, so they actually did just fine as long as they were willing to hold it and not. But here's the thing, that's theoretical. Most people will actually oftentimes sell way at the bottom, and that's why you oftentimes see massive volume on these market declines, because everybody wants to get out at the same time. So oftentimes, despite the fact that people say if you're going to be a long-term investor, you should have the discipline not to sell then, if that's your strategy. Oh wow. He doesn't like that strategy. Hey, should I buy Google stock? Oh wow, look at these stocks. Wow. Wow. He was a little too excited. I never saw anything like that before. I don't even know where we're going. We're going the wrong way. Okay. And another reason why it actually is a great idea to consider the Roth IRA, especially at a time like this, is it's especially because we've had a significant market crash. Now, if the market does not actually go down further, this may actually be one of the best time periods in history to actually invest, because if it's the start of a bull market, usually this is a time where prices are pretty cheap. Like 2 or 3 or 4 years from now, you're going to say, wow, I should have been buying in my Roth IRA and not paying any tax on this wonderful gains that I'm getting here. So if this is the beginning of a bull market, it's even better time period to have the money in the Roth IRA, because it's all tax-free, and you're going to have to thank me and smash the like button and subscribe because of these wonderful tips, because I helped you get to $2.2 to $2.3 million, especially if you're in high school right now. So see you next time.